Today is April 18, 2:50 p.m. and we saw unusual options again on Netflix. Earnings will be reported after hours. Yesterday we made a video on this where we were more bullish on this trade. However, after seeing these unusual options today, we're going to actually be making an addition, actually improving the trade. We're going to get right to it and show you how we're doing it. And so, based on these unusual options that we saw today, this was done at 11:42 a.m. You'll see these May 19s, 3,750 of them, these 250 puts, and then 320 strike puts, 2,500 of them, right? So what does this all mean? So we're going to do a quick analysis of this. This is the 290 and 320s at the May 19s, and you'll see that here, right here. And we got to make sure actually to get that we'll adjust the ratios a little bit later. But we want to just show you what it is. Here it is. You'll see here the 320s are right here. Opened interest is less than the volume. Same over here as well. Okay, so they had bought these 320s and sold the 290s, right? And if we analyze this, you'll actually see this is the trade. It was a back ratio, but let's get the ratio correct, right? So the ratio that they did was 3,750, 2,500. That's actually a ratio of 1.5. So you could see that 3,750 divided by 2,500, that's 1.5. It's still a ratio spread. But let's put the exact numbers in there so you can see what this is. So the 3,750 is here, and then the 2,500 is here. And so what you see here is this, it's a bearish trade. It's a bearish back ratios trade. So that when the price, if the price were to go down, it will become more profitable. Up till this break even here. This break even is all the way at 230, right? And if Netflix does go up, the loss here is minimal, right? They're capped at their losses here. So this line is just flat. It doesn't go down more, so the losses aren't increasing because it's not going deeper down from the zero line, which is this is the profit loss on the y-axis. So that's their way of hedging for this trade. This trade does take a lot of buying power because you are selling a lot of puts here. And so this is a large institution putting on this trade here. And so if you remember our trade back, let's open that here. And by the way, this 1026 one you see here, you also see these 1018. We didn't go over, we're not really, we're going to ignore this one because this is a bit more farther out. This is actually March 2024, very far out in 300 days or so. This looks like a reverse calendar spread to us where they're actually taking advantage of the volatility, and actually it also takes a lot of buying power. But this is like doesn't necessarily mean that they think it is going to go to 340. It's a reverse calendar spread. You can look more up on what that kind of a strategy does, but it's a volatility trade and also, very far out in dates. So we're just focusing on the big elephant trade today at 11:42. Okay, and so if you looked at our trade that we put on yesterday, this was our trade here where we got the May 19th here. Our position is, you'll see here, actually this is our position here that we did yesterday, the 370 strikes. This is our bullish. The other ones was actually, this other one here is actually our additional trade, which we're going to show you. We added this trade on because of today's unusual options activity. So our trade we did yesterday was this 370, and then we sold the I believe it was the 382s. Yeah, that's it. 382.5. So we did this trade yesterday, and it's if you analyze it, it's actually still on our analysis here. This was the trade we did yesterday where we were bullish. And if you haven't watched that video that we put on yesterday, we'll put that link up here. Make sure to watch that so you understand what's going on here. And also, at the end of the video, we can also put that link in also on the description below. And so we were originally more bullish, but now we are going to take a more cautious approach because our break even here right now is pretty much around here where the stock is at 334, right? It is a loss if it goes down below. We had paid about 551 for this trade. So because of this trade now that we're seeing this unusual options today, the day right before earnings, it's basically one more hour until earnings, right? It's 2:57. So what we're doing now is we're going to do a bear trade that is actually going to also take advantage of the volatility. So what we did was we sold the 300 and for the ones that expires on April 21, and then we bought the puts for May 19 at you'll see here the 305s here, right? And so what we did then is we created another diagonal trade. So this is our diagonal trade that we created now, in addition today that we put on. It profits if this goes down in price. You'll see here if it does drop from 334 and drops all the way down, it is profitable because this is all above the zero line, right? And so this is our bearish trade in case Netflix does go the other side. And so what happens is if you put this bearish trade with our trade yesterday and you put them all together, you end up getting a double diagonal. You'll see here two different spots where there's max profits here, right? And what you notice is actually our break evens is actually has been moved down. Now our break even has moved all the way down to 280. You'll see here this red line here. This is our break even now at 280. So that's what's great about this, is that by adding on this trade, we've moved our break even less. And if Netflix does rally, we will still be profitable because this is all positive. This is all above, right? The least amount of profit, right, is actually where it is at 334. So the chance of it not moving at all is very unlikely because earnings is usually, it either goes up or it'll go down, right? So that's why we really like this double diagonal trade. And also if it does drop and basically crash all the way down, our losses are minimized here to just 500, about 500 per contract, which is about 50% of the entire trade, because yesterday when we put on the trade, we paid about 551 for this, 500 for this. And then today we paid about another 500 for this bearish trade. So at most, we would only lose about 500 on this trade if it crashes, right? Otherwise, if it just stays, if it doesn't drop below 280, anything above that from here on, it will be profitable. And so if you look at the charts, 280 is actually, well, it's actually all the way down there. We got to zoom out. So 280 is all the way down here, right? It's all the way down there. It hasn't dropped that low in a while. So all the way 280 is right here, right in the beginning of the, like around that date, right before the new year started. That was, so that's the support where strong support here, where we don't think it will necessarily drop below that. Again, you know, earnings could be a surprise as always, but if it does drop, we don't think it'll drop very much, and there's a higher, so as long as it just stays above that, we'll be profitable. And so that's why we like this double diagonal trade, by adding on an additional diagonal trade on the next day to take advantage of this high volatility right before earnings. It gives us that advantage to leverage options in our favor. Okay, so it's something to consider. You don't have to always put all your positions on in one day, but you can slowly leg into them and ladder in, right? Okay, so less than an hour and the earning market will be closed. So we have a couple of things we still need to do. So hopefully this was helpful and you've learned something. And if you did, please smash that like button so we can keep making these videos. It motivates us, encourages us to keep making videos when we see more people participating and finding benefit to all of this. So please subscribe and hit the bell icon and you'll be notified when we have more unusual options. Take care.